Don't look now, but General Motors is one of the best performing companies in the auto industry, even outperforming Tesla by a wide margin over the past year. And that continued on Monday as the company reached an agreement with the United Auto Workers, with the union, in relation to its battery facility. This is a 50-50 joint facility with LG. And this just takes another risk off the table, especially with the company moving to more and more electric vehicles, starting to ramp that up with some launches that are happening in 2024. We should see more EVs in 2025 as well. And after ratifying a deal with the UAW in 2023, this now increases in certainty for the company going forward. So I want to go through that news today. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So let's get right into the news. This is from the Detroit Free Press, and you can see that this agreement covers the manufacturing plant in Ohio that is going to produce the Ultium cells. So this is a joint venture partnership between GM and LG Energy Solutions. Wages are going to be up to $35 per hour after 1 year on the job. The plant employs 1,700 people and is near the company's Lordstown assembly plant. So this is going to be a critical supply for EVs in the future, and that's really the reason that this was such a critical agreement. This was actually an offshoot from the deal that happened last fall when most of the company's union workers were on strike. One of the questions was what was going to happen with some of the battery plants, in particular this plant. So this basically takes that risk off the table. This is going to be voted on as soon as this week. So this is really good news, both for union workers and for the assurances that GM has that they're going to have supply for batteries and an ongoing contract for a number of years with most of the workers that they have in the US and Mexico, which is agreed to earlier this year. The reason this is such a big deal for GM is the business is doing pretty well right now. I'm going to show a chart that has the company's gross margins and operating margins. And what you want to see is GM generating consistent margins, and then I'll get to cash flow in just a second. But you can see here that the one downside from a margin perspective was the fourth quarter of 2023. That was when the strike happened. So what happens when you have a union that's on strike like GM had, you're producing fewer vehicles than you would have otherwise. That means that your fixed costs, and there are a lot of fixed costs that go into manufacturing, are spread across fewer sales. So that's going to impact both gross margins and operating margins. But you see that in the first quarter, things rebounded really nicely. Management also gave very strong guidance for 2024 and actually increased that guidance slightly after the first quarter. So the business is doing very well, even after they gave the new contract to the UAW in fall 2023. That now is extended to another union deal, more related to electric vehicle manufacturing specifically. So it seems like there's some sort of labor peace, and this is good news because cash continues to come into General Motors. This is a look at free cash flow for General Motors. And this may be a little bit surprising if you don't follow GM closely, but this is a very, very strong free cash flow business. Just continues to generate money year after year. And I'll put this into a little bit of context. The company's market cap is only $52 billion. GM is buying back almost 20% of its shares outstanding with this cash flow right now because there's not a lot of other places to invest cash. There's not a lot of growth avenues in the auto business. They've cut some spending on the cruise side of the business. They've cut spending on the investment that they're making in electric vehicles because they become more efficient. So this is just a money-making machine now. So what you want to have if you're making money and you're doing really well financially is labor peace. That's really the biggest risk that GM faces right now. And with this latest deal, it appears that we have exactly that. And the market's reacting pretty positively. As I'm recording on Monday, shares are up 4%. Year to date, they're up 32%. So a lot of really strong momentum for General Motors. And this is only going to help that. And I think things are going to get even better as we make this transition to electric vehicles for a couple of different reasons. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. As we move to EVs, GM has a couple of things going for it. One is the company's already starting to introduce some of the lowest cost electric vehicles in the market. The Equinox, which is slightly smaller than the traditional ICE Equinox, is going to be under $30,000 after federal tax credits. So this is going to be one of the lowest costs. I think GM has actually said it's going to be the lowest cost electric vehicle. That may be a little bit dated now as prices are adjusted across the board. But it's very clear that most of the growth and investment in the auto market is in electric vehicles. That gets to where GM generates most of its cash. Their cash is actually coming from trucks and SUVs. And we have not seen electric trucks and SUVs sell in big numbers. That means that the sales that do exist for trucks and SUVs are going to lean very, very heavily towards internal combustion engine vehicles. And their prices are going to be pretty attractive because there's only a few suppliers in the market. In the US, you basically have Ford and General Motors dominating the market with a couple of other relatively small players. But GM has, I think, the most compelling vehicles in both trucks and SUVs. That has led to the really strong results that we've seen from a financial perspective that I talked about earlier. This is at the same time that a competitor like Stellantis is starting to struggle. So everything seems to be going really well. And the traditional ICE truck and SUV side of the business is just going to be a cash flow machine. So if you're looking at GM as an investment, that's really the core. And then the future growth is going to be the electric vehicle side of things. We'll see how they do launching those vehicles, getting to a positive gross margin, and then Cruise. That's ultimately where I think there's the biggest upside, is in that autonomous driving unit that could add not only subscription services to some of their traditional vehicles, but also the entire autonomous fleet that Cruise is building, first in Phoenix, and then they're moving into Dallas as well. And even if there's hiccups along the way, GM has the balance sheet to withstand that. GM's balance sheet, and I want you to focus on the automotive side, because what they're doing when they report their combined or consolidated results, which is right here on the right, is they're combining GM Financial, which is basically a bank. So you're going to have the same assets and liabilities that you have as a bank. That's why there's $70 billion of debt down here, $36 billion here. When people say that GM has a ton of debt, what they're really saying is they own a bank. So let's focus on the automotive business right here. Nearly $20 billion in cash and marketable securities in the auto business. There is some debt, about $16 billion in long-term debt. There are some liabilities like pension and post-retirement benefits, but the balance sheet is actually pretty strong. And if you go up to what they're expecting for 2024, now this is as of April 23rd, they're expecting net income to be over $10 billion. $10.1 to $11.5 billion. Automotive operating free cash flow, $18.3 to $21.3 billion. Ton of money coming in. Adjusted free cash flow coming from the auto business, $8.5 to $10.5 billion. That's up $500 million from their guidance that they gave to start the year. So all signs are that GM's business is hitting on all cylinders. The stock only trades for still about 5 times earnings. So I wouldn't be surprised if later this year we have another massive buyback. They announced about a $10 billion buyback program. A lot of that was accelerated late in 2023. That's going to push their share count lower, should push earnings per share higher. And if they do another one of those buybacks at the kind of price where the stock is trading at now, I think there's tremendous upside, because the ICE business isn't going anywhere. The truck and SUV business for internal combustions isn't going anywhere. And we're starting to see a little bit more evidence that GM is going to do relatively well in electric vehicles as well. So I think things are pointing in the right direction for GM. Not the most popular stock, and it's understandable why. This is the company that was supposed to be disrupted by innovators like Tesla and Rivian, but the financials are telling us that the company is doing extremely well. And so that's why I own shares of GM and continue to be long the stock. But what do you think? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.